Welcome to This Explainer. Today, we're unpacking the trade desk's Q1 2026 earnings report. Now, if you follow ad tech, you know this company is an absolute beast, a leading independent demand-side platform. But this quarter, well, it's fascinating. We're seeing a massive disconnect between some really flashy, optimistic headlines and the hard, objective financial realities underneath. We're going to break the whole thing down, step by step, using the raw data straight from their filings and earnings calls. Let's get into it.
Okay, here's our roadmap. We'll start with a quick Q1 2026 snapshot, dive deep into the financials, look at their CTV and audio growth, assess those macro headwinds, and finally, we'll wrap up with Wall Street's final verdict.
All right, Part 1, Q1 2026 Earnings Snapshot.
You know, context is absolutely everything. CEO Jeff Green actually reminded investors that they aren't playing small ball here. They are going after a massive $1 trillion total addressable market. Positioning themselves as the premier objective platform for the open internet, well, that really explains their hyper-aggressive reinvestment strategy.
And you can really see that scale playing out today. For the first quarter of 2026, the trade desk brought in $689 million in revenue. That's a super solid 12% year-over-year growth. When you're swimming in a $1 trillion market, top-line growth is basically the ultimate scorecard to show you're still snatching up those ad dollars.
But if we peek just behind that top-line number, it's honestly a bit of a mixed bag. They beat revenue expectations, sure, and posted a really strong adjusted EBITDA of $206 million, holding a 30% margin. But then you look at earnings per share. It came in at just 8 cents. That completely whiffed the consensus estimate of 32 cents. So you gotta ask yourself, how on earth does a company beat on revenue but miss so spectacularly on the bottom line?
Well, to answer that, let's move to Section 2, diving into the financials.
The real answer? It's sitting right here in their operating expenses. Yes, revenue and gross profit grew really nicely year over year, but operating expenses remained stubbornly high, hitting $440 million. That's being driven by platform operations, AI tools, and a growing headcount. And all those costs are actively squeezing their operating margins down to just 9.7% for the quarter. And honestly, this feeds into a broader, kind of concerning trend. Don't get me wrong, revenue is absolutely growing, but this chart clearly shows the pace of that year-over-year growth is decelerating sequentially. We've gone from a 17.7% growth rate in Q3 of 2025 down to just 12% for Q1 2026. And as we all know, Wall Street pays a massive premium for accelerating growth, not decelerating.
Plus, there's this hidden tension sitting right on the balance sheet. On one hand, you have a fortress of liquidity, literally $1.4 billion in cash and short-term investments, zero long-term debt. Amazing, right? But on the other hand, that liquidity is anchored down by bloated working capital needs. We're talking over $3.3 billion in accounts receivable and $2.6 billion in accounts payable. That is a ton of cash just tied up in their day-to-day operational cycle.
Now, management is completely aware of this. Leadership vigorously defended this exact posture on the call, framing 2026 as a year of disciplined reinvestment. They are purposefully pouring cash into infrastructure and agentic AI. To them, this cyclical pressure isn't a flaw, it's a feature. It's the exact time to reinvest and lock down their future.
Which brings us nicely to Section 3, CTV and audio growth.
Just look at this breakdown. Connected TV and video are now the undisputed core of the trade desk's business, making up 52% of their total mix in Q1. As ad dollars continue that massive, historic migration away from old-school linear TV and over to streaming, these guys are positioned perfectly to catch that wave. And those heavy platform investments we talked about? They're already paying off. They ran tests for a new feature called Audience Unlimited and saw a 75% more efficient cost per action, plus a 2.7 times higher conversion rate. I mean, for advertisers, that is incredibly compelling. It means way more bang for their buck, and that's exactly how the trade desk proves its worth and keeps clients hooked.
On top of that, they are absolutely crushing it in the retail data space. Because they don't actually own the media they sell, retailers trust them as this objective, neutral partner. Get this, the trade desk now covers over 80% of the top US retailers. Compare that to walled gardens like Amazon, which cover less than 15%. It lets advertisers tie their ad spend directly to actual real-world sales. Huge advantage.
But it's not all sunshine, which leads us to Section 4,
macro headwinds and risks.
During the earnings call, management was actually refreshingly transparent about the current climate. Interim CFO Tynell Davis pointed out that geopolitical uncertainty is making clients, especially those massive brand advertisers, super hesitant and cautious with their ad spend right now. And it makes sense, right? When the world feels unstable, the marketing budget is usually the very first thing to get slashed.
What really stands out to me here, though, is how concentrated their risk profile is. Beyond the broad geopolitical fears, they are seeing very localized weakness in consumer categories like CPG, home and garden, and food and drink. And since roughly 82% of the revenue is tied directly to the U.S. market, any little hiccup in domestic consumer spending in these sectors is going to hit their bottom line disproportionately hard.
And these aren't just theoretical what-if headwinds. They are actively eating into the company's margins. Just look at the trend. Gross margin peaked at 82% in late 2024. In Q4 of 2025, it was still hanging strong at 81%. But Q1 of 2026, it dropped sharply to 74%. That is the lowest point we've seen in an 8-quarter stretch. The actual cost of generating their revenue is simply going up.
So what do the pros think about all this? Let's check out Section 5, Wall Street's verdict.
The short answer? Wall Street is totally split. Just watch how the sentiment took a nosedive over the course of May, right after the earnings dropped. Before the report on May 4th, Wedbush actually upgraded their target to $23. But then, shortly after earnings, HSBC downgrades it to $20. Fast forward to late May, and Rothschild & Co. slapped a full sell rating on it with a shockingly low $11 price target.
Because of all this mixed signaling, analyst models are literally all over the place. On the super bearish end, you've got Rothschild at $11, predicting some serious downside. The consensus average is sitting around $41. But then on the highly bullish side, firms like BTIG are holding firm with targets as high as $97. They're basically betting the house on that trillion-dollar TAM and the inevitable total dominance of CTV.
Now, if we want some objective grounding away from all that pure analyst noise, the financial platform Ticker ran their data-driven valuation model on the trade desk. Their model currently prices the stock's fair value at around $36. Considering the stock was trading in the low 20s around this time, that implies a massive upside of over 50% from current levels. It kind of suggests the broader market might have completely overreacted to the margin compression news. Ultimately, evaluating the trade desk right now is this crazy balancing act between short-term pain and long-term vision. The numbers really force us to ask a critical question. Are these heavy, immediate investments paving the way for total future dominance, making this dip an unbelievable buying opportunity? Or are rising costs and slowing growth rates just the new, permanent reality in a maturing ad tech market? I'm going to leave that up to you to decide. Thanks so much for joining me for this explainer, and keep learning.